The United States government and other governments around the world typically work to prevent and mitigate economic crises through a variety of measures, such as fiscal and monetary policies. These policies are often discussed and debated in public forums, and their effectiveness is evaluated and scrutinized by economists and other experts. So in this video, we are going to discuss new economic crisis coming U.S. government trying to hide. The video is going to be amazing. Make sure to stick till the end. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. It is worth noting that the global economy is constantly evolving, and it is not uncommon for economic crises to occur periodically. It is also important to note that the media and other sources of information often report on economic developments, including potential crises, and it is unlikely that the government would be able to completely hide such information from the public. However, it is always a good idea to be informed and to seek out multiple sources of information when making important decisions about investments or other financial matters. Economic crises are characterized by a significant decline in economic activity, typically marked by a contraction in GDP, rising unemployment, and financial distress. Such crises can have a widespread impact on various economic sectors, affecting businesses, consumers, and governments alike. The most common causes of economic crisis include financial market crashes, banking panics, inflation, recession, and war. Historically, economic crises have had a significant impact on the United States and the global economy. The most recent global economic crisis occurred in 2008, following a housing market crash that led to the collapse of major financial institutions and a subsequent worldwide recession. The crisis led to high unemployment rates, decreased consumer spending, and widespread financial distress. Since the 2008 crisis, the U.S. government has taken several measures to prevent future economic crises. For example, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010 to strengthen financial regulations and oversight of financial institutions. Additionally, the Federal Reserve has taken steps to ensure financial stability, such as implementing stress tests and increasing transparency in monetary policy. However, despite these efforts, the U.S. economy remains vulnerable to economic crisis. The ongoing COVID-19 pandemic has highlighted some of these vulnerabilities, such as the dependence of many businesses on global supply chains, the lack of access to affordable healthcare for many Americans, and the precarious nature of many workers' employment. While there may be some indications that an economic crisis could be looming, it is important to note that predicting economic events is challenging and often subject to error. It is also essential to consider the potential impacts of spreading false information or conspiracy theories, which can create unnecessary panic and harm the economy and society. In conclusion, economic crises can have a significant impact on the economy and society, and it is essential to take measures to prevent and mitigate their effects. While it is important to remain vigilant and aware of potential economic risks, it is also crucial to avoid spreading false information or engaging in conspiracy theories that can harm the economy and society. This past week brought home the magnitude of the overlapping crises assailing the global economy, intensifying fears of recession, job losses, hunger, and a plunge on stock markets. At the root of this torment is a force so elemental that it has almost ceased to warrant mention: the pandemic. That force is far from spent, confronting policymakers with grave uncertainty. Their policy tools are better suited for more typical downturns, not a rare combination of diminishing economic growth and soaring prices. Major economies, including the United States and France, reported their latest data on inflation, revealing that prices on a vast range of goods rose faster in June than any time in 4 decades. Those grim numbers increased the likelihood that central banks would move even more aggressively to raise interest rates as a means of slowing price increases, a course expected to cost jobs, batter financial markets, and threaten poor countries with debt crisis. On Friday, China reported that its economy, the world's second largest, expanded by a mere 0.4% from April through June compared with the same period last year. That performance, astonishingly anemic by the standards of recent decades, endangered prospects for scores of countries that trade heavily with China, including the United States. It reinforced the realization that the global economy has lost a vital engine. The specter of slowing economic growth combined with rising prices has even revived a dreaded word that was a regular part of the vernacular in the 1970s, the last time the world suffered similar problems: stagflation. The U.S. economy is a complex system that is influenced by a multitude of domestic and global factors. Some of the key indicators that economists use to assess the health of the economy include GDP growth, inflation, unemployment, consumer spending, business investment, and international trade. When these indicators start to trend downward or become unstable, it could signal an impending economic crisis. One factor that could trigger an economic crisis is a sudden shift in global markets. The U.S. is highly dependent on foreign trade, and any significant disruptions to global trade could have a severe impact on the economy. For instance, the ongoing trade war with China, which started in 2018, has led to increased tariffs and reduced trade between the two nations. This has resulted in higher prices for U.S. consumers and reduced profits for U.S. businesses that rely on Chinese imports or exports. Another potential factor that could contribute to an economic crisis is a significant increase in debt. The U.S. national debt has been steadily increasing for decades, and as of 2021, it stands at over $28 trillion. While some economists argue that a high level of debt is sustainable as long as the economy continues to grow, others warn that too much debt could lead to a debt crisis if interest rates rise or if lenders become wary of lending to the U.S. government. A third factor that could contribute to an economic crisis is a significant decline in consumer spending. Consumer spending accounts for a large portion of the U.S. economy, and any significant decline in spending could lead to a recession or depression. Factors that could lead to reduced consumer spending include high unemployment rates, rising prices for goods and services, or a decline in consumer confidence. While these are just a few examples of factors that could lead to an economic crisis, there are many other potential triggers as well. The important thing to keep in mind is that economic crises are often unpredictable, and their effects can be far-reaching and long-lasting. If a new economic crisis were to occur, how might the U.S. government respond? One option would be to implement monetary policy measures such as lowering interest rates, increasing the money supply, or implementing quantitative easing. These policies can help stimulate economic growth and encourage businesses and consumers to borrow and spend more money. Another option would be to implement fiscal policy measures, such as increasing government spending or cutting taxes. These policies can also help stimulate economic growth and put more money into the hands of consumers and businesses. However, implementing these policies also has potential downsides. For instance, lowering interest rates can lead to inflation, while increasing the money supply can lead to a decrease in the value of the currency. Similarly, increasing government spending or cutting taxes can lead to a larger budget deficit and increased national debt. Moreover, the effectiveness of these policies may be limited by political considerations or by global economic conditions. For example, if the U.S. is already heavily indebted, it may not be able to implement expansive fiscal policies without causing concerns among its creditors. Similarly, if other major economies are also experiencing economic downturns, it may be difficult for the U.S. to stimulate its own economy through exports or foreign investment. In conclusion, while it is unclear whether a new economic crisis is imminent or whether the U.S. government is attempting to hide it, there are many potential factors that could lead to an economic downturn. If such a crisis were to occur, the U.S. government would likely respond with a combination of monetary and fiscal policies, although the effectiveness of these policies may be limited by political. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.